Hello, friends. My name is Vikas Agrawal, and I'm the founder and CEO of AIF PMS Experts India. Well, markets are very volatile at this point of time. A lot of investors are really concerned and confused what should be the right strategy. What I thought is I'll kind of share a few data points that I've collected from various sources, and let's have a look over the markets over the past 30-40 years and try and analyze that how has been the behavior, because when we do not know the future, it is always said that one should look at the history and then evaluate. So I'm not wasting time here. Let's go to the slide, and I would like to share a few slides with you. uh, so the what I'm going to do is I will share the data points with all of you of last 30 years and see how markets have behaved over a period of time, especially the equity markets vis-a-vis other asset classes. So when I look at equity returns, and this data is on 31st of March 2022. So if you look at last 15 years of data points, so last 20 years of data points, the equity, which is Nifty 50 try, has delivered 12% returns in last 15 years and around 16% for over last 20 years. If you compare that with US equity markets, so US has delivered 14% returns, which is higher than 12% of Indian equity markets in last 15 years. Uh, and then last 20 years is about 11.8%. Now let's look at the debt fund return. So debt as an asset class has delivered 7.9% in last 5 years and around 7.4% returns in last 20 years. Surprisingly, gold has done better in the last decade. And if you look at last 15 years of data points, gold has ended up delivering 11.5% return. Well, some of you might be surprised to notice that is very much close to the equity markets of returns of India. And last 20 years, it has delivered 12.2% returns. Let's look at the now how many times in multiples it has grown. So if you look at Indian equity markets, the Nifty 50 try return last 15 years is it has grown by almost 5.5 times. Uh, and your gold has also, as I said, that the returns are close to equities in last 15 years, surprisingly. Therefore, it has also grown by 5 times vis-a-vis debt, which has grown 3.1 times, and US equity, which has grown 7.7 times. So last 10 to 15 years belongs to US. Of course, the market Nasdaq has done very well, both Nasdaq and S&P 500. But what is important to notice here is if you look at last 20 years, it took us 15 years to have 5.5 times of returns, but in 20 years, it has delivered 20 times. So as there is a saying that the longer the period in equities, the better the returns, because that is where your power of compounding really starts working. So in 20 years, Indian markets have equities have delivered 20% CAGR. This is I'm talking about the benchmark, not comparing that with mutual fund PMS or AIF portfolio managers. Vis-a-vis the gold, which is about 10 times, and US equities 9.3 times, and debt is 4.2 times. Now let's look at the journey of equity markets and the volatility. Now, if you look at since 1990, so it's been about 32 years now. In 32 years time, ever since Nifty 50 has begun since inception, the benchmark itself has delivered 14% CAGR returns, in multiple of 62 times in 32 years, to be very precise. Now, when you look at compare the other benchmarks, last 15 years, the S&P BSE Sensex TRI has delivered 12%, which is very much close to Nifty returns, and 20 years 16%. Whereas if you look at the mid cap returns, it's about 11.9%. Now, what I want to highlight here is there is this debate which always goes on that mid cap and small cap delivers higher returns than large cap. But if you look at last 10, 15 years of the data points are clearly reflecting that both large cap, I mean, all three of them, large cap, mid cap, small cap, have ended up delivering similar sort of returns in last 15 years. And particularly last 10 years in India, a very fearful situation. Therefore, large cap as a category has done well, I would say. So credit goes to large cap here. Uh, the same thing, if you want to multiply, so in last 15 years, your BSC Sensex has grown by 5.5x in 15 years time, vis-a-vis mid cap, which is 5.4, very close to large caps, and 5.2 times of small cap, which is again very close to the overall Nifty 500 returns, which is about 5.6 times in last 15 years. Mid caps and small caps do not have 20 years of history because the inception date is lesser than 20 years. Therefore, the 15 years of data points have been captured here. Now, when you look at global equities, last 5 years, as everybody knows that Nasdaq has done very well. It has ended up delivering 27% returns. All this data is as of 31st of March 2022. When you look at the developed economies, they have delivered 14% returns vis-a-vis the emerging markets, which is 6.9% in last 5 years. Since MSCI emerging market has 10 years of history, therefore the 10 years returns are in the tune of 5%. Vis-a-vis US markets or S&P 500 is about more than 19%. Again, in terms of multiples, and Nasdaq has delivered 3.3 times in 5 years and almost 18 times in last 20 years, whereas MSCI index, which has only the world, which has only 5 years of history, is almost closer to double, I would say 1.9x. And your MSCI emerging markets, which is composite of emerging markets like Brazil, Russia, China, India, and some of the other emerging markets, their returns are in the tune of 1.4x in last 5 years and 1.6x in last 10 years. So clearly, it indicates that Indian markets have done much, much better than these emerging markets. Now, if you look at the Nifty 50 try rolling returns, on 15-year rolling basis, large cap index Nifty 50 gave more than 12% returns in 92% of the time since 1999. So as you can see that uh, the longer the time horizon, and if you have horizon of more than 15, 20 years in equities, there are possibility that 92% of the time Nifty has delivered more than 12% returns. So, uh, that clearly indicates that if you have patience in Indian equities, it is going to pay you off. The other thing to be noticed here is if you look at Nifty 50, percentage of negative returns since inception. Increasingly the investment time period has historically lowered the likelihood of losses. I'm talking about the negative returns. So it has been observed that if you have invested in equity markets for 5 years, I'm talking about the benchmark, there is only 0.1% possibility that you end up losing some money. Otherwise, no. If you've invested for 3 years, there are possibility that 8% a possibility that you can lose your money. But otherwise, if you choose the right portfolio managers and good quality companies, there are possibility that even in 3 years time you make money. But if you look at 7 years and 10 years, you can't, even if you wish to, you can't afford to, you can't lose the money in equities. That's how the historical return clearly suggests that. Now, there's, as I said, there's a saying that the longer the time horizon, the better the possibility of returns and higher the odds of better returns. So it clearly indicates that if you look at 7 years of time, 98% of the time that markets have delivered positive returns. And only 2% chances are there that you lose your money. So returns have been more than 7%, if you look at, and returns 10% if you look at more than 10% returns ever since the Nifty has started last 10 years of data points. There are 80% time that you end up making more than 10% returns if you would have invested for 10 years time. Then the this is a very important slide that I want to highlight. So it basically gives you a kind of declines, the drawdowns of the market. So equity markets, I mean, historically, if you look at have witnessed 10 to 20% temporary declines almost every year. Is not even single year. And if you look at the data points since 1980, it is showing the chart that since 1980 to 2022, 31st of March, almost good 42 years now. 42 years is a good time frame to look at how has been the trend or the pattern. And what is more important here is if you look at almost every year, market has temporary declines of 10%, 12%, 19%, as you can say 12%, then again 9%, 19%. Likewise, so only 3 out of 43 calendar years, it had an intraday decline of less than 10%. So you can say that 10% drawdown is very much possible when you are investing in equity. And if you don't have the stomach to digest that, then probably this is not the asset class for you. So very important slide to be looked at. The other slide, which is very, very important here, is despite an intraday decline of more than 10% nearly every year, 3 out of 4 years ended up with positive returns. So as you can see that here, there are declines like in 1980, 1981, 1982. You see there have been a decline of 19%. But when you look at the same year, it has ended up delivering positive returns. Look at 1981, it has delivered 50% return. Of course, Sensex size used to be very, very small. The Sensex number used to be 100 out here. But despite all that, if you look at, there are years when the equity market would have delivered 10% decline in a particular session or a particular month or two, but then same year it has ended up delivering almost positive returns, almost by double 90. Here in 1985, it delivered 94% positive returns in 1991, 87%. Then you had best of the best year like 2009 after the decline of market by 51%. You had a fantastic year of 76%. So what it indicates that the returns, average returns are in the tune of 19%. If you look at the positive sides, this line, and if you look at this line, if you look at this line, which has witnessed the negative returns, the decline, temporary declines, the drawdown average is about 21%. So you can say that for making 19% consistently, you have to have a drawdown drawdown percentage of 20 drawdown appetite of 21%. So despite the market having intraday decline every year, only 9 years out of 42 years had a negative return. Which are those negative years? You can see 1986, when markets fell down by 27%, and year also got ended up with negative returns of 1%. Then again 1987, then you had 1995, 1998, 2000, 2001. This was a dot-com bubble. I think this was Arshad Mehta. Then 2007, of course, this is a Lehman Brothers crisis. Then you had the break. I think thereafter, you see, year on year, it has ended up delivering positive returns. Okay, so we'll move on to the next slide. Uh, okay, yeah, this is another interesting slide. So 51% of the day Sensex trades at a discount of 10% or more from the peak levels. So historically, it has been observed that if you markets have already has trade generally between 10 to 15% of discount, and it is about 51% of time, so more than half of the time your markets trades at a discount of 10 to 15% from its peak. Then again, yeah, there's a very important slide here. Temporary market declines of 30 to 60% historically has occurred every 7 to 10 years. So if you look at the peak data, if you look at some of the examples here, so if you look at the data, for example, in 1986, 4th June, the market value was Sensex was at 659, and then it has a correction, which was on 28th of March 1988. So almost 1 year and 10 months. During that period, market fell down by almost 41%, and it recovered on 30th of September 1998, and that was the time when Sensex value moved from 659 to 63. So the time taken for fall was 1 year and 10 months. But what is important to notice here is that the recovery time was only 6 months. And if you add these two, which is time taken to fall down and then recovery, the total period was 2 years and 4 months. Same thing if you look at in 1990, when market witnessed 39% downfall. And again, it took about 4 months time to fall down the market, and within 6 months it recovered. So within 10 months, everything was back to the same level. Then again, 1992 to 1993, everybody knows this Harshad Mehta time, etc. When market fell down by almost 54% from 4,400 levels to 2,000 levels, and then again it came back to the same level in 1994, which was 12th of August. That was the recovery date. Again, it took 12 months time to fell down, and it took hardly a year and 4 months to bounce back. Then again in 1994, market fell down by good 41%, and it was there for almost 2 years and 3 months. That was a very dull period for Indian economy post the reforms taken by our Prime Minister Manmohan Singh ji, and that was a time when Harshad Mehta and thing got over, and the other scam started. And then it took about 2 years and 3 months time to market to fall down, and it took another 2 years to recover. So that was 4 years of time frame, which was considered to be the longest time frame for recovery in Indian equity markets. Thereafter, in 1998, again, market fell down by good 35%, but then within 8 months, it recovered very well. During the dot-com bubble, again, market fell down by 56%, and a lot of people who invested in IT companies those time lost out as much as 56%, and it recovered well in 2 years' time. Then 2008 was the Lehman Brothers crisis, when market again fell down by 61%. This was a global meltdown as well, and it hardly took 1 year and 8 months to come back to the same level. And 2020, of course, everybody knows COVID-19, when the entire world was locked up at their residence, and nobody was allowed to go out, and all the economy shaken up, and the market fell down by good 38%, in line with other global markets, which went down by 45%. But we hardly took so it took only 2 months time. That was the lowest time frame to see this kind of sharp downfall of 38%, and it took hardly 8 months time to recover well. So the total time frame was only 12 months, which is less than a year. If market bounced back very well. So this data clearly loudly speaks that historically large market falls of more than 30%, and subsequent recoveries have taken around 1 to 3 years time. Therefore, it says that If you're entering in equity markets, you should have a horizon of minimum 5 years time. Otherwise, you should not be investing in equities. Then if you look at every decade saw one or two sharp declines of more than 30%. Uh, so, if you look at the frequency of the market declines, Sensex drawdowns from 1980 to 22. This is very, very important slide. If you look at between 10 to 20%, uh, and if you look at the decade wise, between 80s to 90s, it fell down by 7 times. From your 90s to 2000, it fell down, but twice the market fell down between 10 to 20%. And 2001 to 10, it was number of falls were three. Then last decade, which was 11 to 22, and this decade, which has just begun, it is 2 times because of COVID 21 to 22. The second one is happening now. Now, if you look at 20 to 30%, which is very sharp, between 80s and 90s, you did not had more than 30% fall decline, particularly. But if you look at the CAGR returns between the same period, 1981 to 1990, uh, your market Sensex has delivered 21% CAGR despite these falls. You had one major fall of 40 to 50% during that time. Then again, you had three major fall downs between 90s to 2000, because you had Harshad Mehta, then you had Farid Khan, and then you had dot-com bubble. So you had three major falls, and once it was market fell down by more than 50%. And despite all that, the CAGR returns for the whole decade is 14.2%. You know, and if you look at between 2001 to 10, it is 17%. 2011 to 20, it is 8.8%, and now it is about again 21%. So what it clearly indicates that despite so many declines, market falling down, etc., etc., you look at 10 years of CAGR returns, except for 2011 to 20, which is said to be a lost out decade for economy like India. It has delivered only 8.8%. Otherwise, all the returns are in double digit. There's a very good slide that says that in last 20, 30 years, if you look at, you had various events lined up, and the market has witnessed all of them. You had, for example, during your 80s time and 90s time, between 80s and 90s, you had a Gulf War, then Iraq, evacuating Kuwait, then Rajiv Gandhi assassination, then economic reform took place in 91, then Harshad Mehta scam happened, then Babri Masjid demolition happened, then the Bombay booming happened, and Vajpayee government fell down. Then you had Asian financial crisis. Then during that time, Prime Minister Gowda resigned. Then you had Prime Minister Gujarat resigning in. Then NDA government again coming back. Then again you had Vajpayee, Mr. Vajpayee government resigning from the PM post, and then you had a Kargil war. Then FI started redeeming the money from the equity markets. Then you witnessed dot-com bubbles. I mean, these are all major events, and you had in between Russian financial crisis. Then again, you had heavy selling by retail investors and FIs investors. You had 26/11 Mumbai attack. Before that, you had a UPA government forming up. Then you had various scams, like you had US financial crisis. Then you had Lehman Brothers crisis. You had Union budget of 9 to 10, then Dubai debt crisis happened, then European debt crisis happened, if you remember, during the Brexit time. Then again, if you look at the major events, and you had election, then you had China yuan depreciating historically on a very higher side. Fed started hiking the rates, the highest was in last decade. Then the Notbandi happened after the demon. Then uh, GST implementation took place. Then government infused almost 32 billion into the PSU banks, and you had NBFC crisis, Saudi Arabia draws. So all these events, you had major state elections, and then FOMC decided to continue QE, Boston Marathon morning. So RBI hiked rate in between, and you had NDA government again coming back, and Sensex hit all-time high. Again, you had COVID, then and then now markets witnessing Russia, Ukraine crisis, and before that we saw what happened in Afghanistan. So and before that you had major crises like Yas Bank crisis in India or ILNFS crisis in India. Despite all sort of events, if you look at your Nifty has delivered 14% CAGR in 32 years time. And if you would have given money to some of the high quality portfolio managers, your money would have grown by more than 100 times. So that clearly indicates that despite several, intermittent crises, Indian equities have gone up over the long run, mirroring earnings growth. So ultimately, you make as much money in the stock market as company makes. There's a very good quote by Warren Buffett that he says that you make as much money in the stock market as company makes, and you see ultimately, uh, despite so much of issues, you had fiscal deficit of 8.3% of GDP in 1985. Then you remember, some of you would have remembered that there was a balance of payment in crisis decline, market decline by 39%. Then Harshad Mehta scam, then political uncertainty which took place between 96 to 97. There were 4 5 prime minister which got changed during that time. Then you had dot-com bubble which started declining the markets, and market fell down by good 40%. We just saw that. Then you had election year FI selling decline of 27%. Market fell down by 29%. Then the global financial crisis came in. Then the European debt crisis came in. Then the markets gone down by 28%. Then global market fell off rapid decline 23%. And then coronavirus, of course, market declined by 38%. But despite all that, if you see in the long run, they're saying that down is temporary and ups are permanent as far as Indian equity market is concerned. So you don't have to really look at these events. Of course, these are key events and one should look out for. But when you are investing in equities, you have to have long horizon, and in the long horizon, you end up making good amount of wealth. And this is the only wealth creation journey. They're saying that if you want to create wealth, you have to go through difficult time. Let's look at between 1980s to 1986, markets have delivered 456% absolute returns in 6 years and 2 months time. And then you had a rough phase of 1 year and 10 months when the markets fell down by 41%. Again, market delivered between 1986 to 19, it ended up delivering 300% absolute return. So as you can see that upsides are much higher than the declines. So you can see the declines are first on a temporary basis for a short period of time. But as you can see that the way markets are going up, and ultimately it has gone up. You look at, for example, between 2000 to 2015, market has delivered 96% absolute returns. Between 15 to 20, it has delivered 83%. So that clearly this is the Sensex returns that I am referring to from 1980s to 2022. It indicates that you make good money in the long run, and even if you would have even if you would have invested right before a market crash, because you can't time the markets, but over the long time frames the returns have still turned out to be decent one. For example, if you would have invested say before the dot-com bubble and you had almost 50% of decline, but despite all that, if you look at Nifty returns, who invested at peak before the fall, Nifty has delivered 12% returns vis-a-vis debt, which is 8%, and you had inflation number of 6%. So even if you consider the inflation adjusted return, your money would have grown at 6%. If you would have invested during the latest example is 2020 before the crash, you know, after the crash, and then your portfolio 1 crore has become say 62 lakhs because you had 30% fall. And from there also, if you look at your portfolio would have delivered 18% returns in last 2 years time. So what it indicates that you cannot afford to time the market, and even if you'd have invested, you say that I'm not so lucky, and even if you'd have invested before the major crisis, despite all that, your returns would have been at about 18%. Again, few data points. So even bull markets have several intermittent declines. If you look at since 2000 to 2001, market had a decline of 56%. One particular year itself was around 41% during the dot-com bubble. And from 2002, when the bull run began, from 2000 to 2007, from there 2001 to 2007, uh, markets have delivered 703% of absolute returns. So these are few examples. Even if you look at and then you had again 2008, which was a bad year, and again market fell down. And from 2009 to 2020, if you look at your Sensex itself would have ended up delivering 414% of absolute returns. So what it says that equity markets are non-linear. Missing few days in the market significantly reduces the return. This is very important slide, and one of the portfolio manager I know, a good friend Samit Vartak, categorically mentioned once during his presentation that if you miss few good days, you don't know which are those good days. It can come in between the bear run also, but then your return goes down substantially. So if you would have invested in the entire period, this is the Nifty index returns that I am referring to, then your returns would have been around 14%, as I mentioned between. We are now referring the data points from 2005 to 2022. So good 17 years of time. But if you would have missed 5 best days, and which are those 5 days, I'll tell you later in the next one. Then you would have your returns would have come down from 14.4% to 11.5%. About, and your 1 crore would have become 65 lakhs if you'd have invested, say, 10 lakhs rupees. If you would have missed good 30 days, 1 month time, your returns would have been only at 3.3%. So your 1 crore would have become 80, your 10 lakhs would have become 18 lakhs in 17 years of time. So therefore, it is very, very important that you do not miss those days. Be remain invested in these markets. You do not know which are those days. Let's look at which are those days. So so if you look at 2006 to 2006, you had 3 good days when market 1 day return delivered 6.3% returns. On 15th of June 2006, on 9th of June 2006, market delivered positive returns of 5.2% in one particular day, and about 4.4% on 30th of June, one single day return. Now you look at 2008, which was like a market falling down by 60%, but 17 of top 30 best days were noticed from this period. So you had 18 May 2009 when 1 day return was as high as 17.7%, and that day most of the stocks hit so-called upper circuit on that particular day. Then you had 31st of October 9 2008 when market had delivered 7% return in particular day. Likewise, you had 2023 March 2009 when market delivered 4.7% returns. Now let's look at the COVID recent example, the COVID time when you witnessed almost 37 to 40% market fall. Then you saw 7th of April 2020, which is just after a month of the lockdown, and the entire world was locked. Indian markets delivered 8.8% returns in one single day, which was 7th of April to 2020. Again, on 25th of March 2020, market delivered 6.6% of positive returns. And 20th of March, it delivered 5.8%. I mean, those were very volatile days. And on 1st of February 2021, it delivered 4.7% of return. So 6 out of best 30 days were Year 2008 times after the Lehman Brothers crisis. Then you had before the crisis 2007, then 2019 and 2007. Now, these were the days when market delivered almost 4, 5, 6, 7% returns in one particular day, which is very much close to your inflation number, what we talked about in a year, 365 days. You had few best days where market covered up everything. So all-time highs are a natural part of any growing asset class and not something to be feared of. So obviously you will have a good phase and bad phase. Uh, Again, very interesting data on the high times automatically don't imply a market fall, and majority of the time returns were stronger in 1 year time. Market has it has been observed that 52% of the time market has delivered more than 15% returns, and this is just some of the examples. Before I wrap up, calendar year returns are volatile and rarely resemble long-term average. So it's basically trying to show you that how has been the returns, and there were a few years when markets were in negative zone of 20%, 40%, even to 50%. But despite all that, you see the number of years which delivered the positive returns. These are much higher than the negative ones. Then equities are less volatile over the long-term horizon. So if you look at long-term horizon, as I said, your between 1980 to 2022, the Sensex returns are in the tune of 15%. So the longer the time horizon, the better it is. Sorry, it is around 20%. Uh, then if you look at, we've just given few examples of some of the PMSs, like for example, there's this PMS started by Motilal Oswal in 2003. If you look at since inception return, because it has completed now around 19 years, the 19 years of consistently, it has delivered 19% CAGR returns. So we have captured the data points of some of the best PMSs, which has now more than 10 years of track record. So like, for example, if you look at ASK IP portfolio started up in January 2010 and delivered 19% CAGR returns in last 22 years. And if you look at, there is this company called Alpha Accurate, which has started this PMS in 2009 and has now almost 19% of since inception returns, and last 10 years returns are in the tune of 20%. So and there is this fund by the name Alchemy High Growth, which was started in 2008, again has around 20% CAGR returns for 13 long years. Then you have Enam, which was started in 2021, the PMS. Again, you look at last 10 years since inception, the returns are in the tune of 16%. So please understand, if your returns move by 1%, then the difference in the overall returns goes up by more than 10%, in the long run of 20%, 20 years. So these were again the returns of these PMSs, which I talked about. You have Motilal, which delivered 15% NTDOP, you have Value Quest Growth Fund, which delivered 17% returns. Then Acura Cap Pico Power is about 24.8% in last 10 years. Uh, then you have a couple of other PMSs like a growth and a value strategy of care. Uh, so Indian equity versus the PMS performance. These are few examples of, like, this is example of Alchemy High Growth when benchmark delivered 16% and they delivered 21%. And these are the returns of some of the funds, like for example, Abacus has delivered 24% returns in last 3 years. These are the benchmark, which is about 16, 15, 16%. Then the volatility is picking up therefore. So basically, the takeaway is that over the long term, 10 to 15 years, equity has provided return above the inflation. Number two is long-term return expectation is inflation plus 4.6, but 10 to 20% decline happens almost every year. So don't get so scared about that. And 30 to 60% decline should be a part of expectation for every 7 to 10 years. With that, I would like to conclude my presentation, and I'd like to take this opportunity to thank all the investors for spending time out here and listening to me. I've collected these data points from various sources. There are few good distribution houses also who have helped us to furnish these data points. There are few asset management companies who have furnished these data points, and with that we've consolidated this and presenting to all of you so that when you invest in equity, you take the informed decision. And you should be aware that 10 to 20% of the drawdown is a normal in equity markets when you invest. And if you have that sort of stomach to or appetite to digest and stomach this, then only you should think about investing. Otherwise, equity is a clear cut no for you. With that, I'd like to thank you and would like to wrap up this conversation.